In the late 1920s, America's chauffeurs, cooks, and factory hands were buying stocks on borrowed money, 10 cents down for every dollar invested. Broker loan debt swelled past $8.5 billion, more than all the cash circulating in the entire country. On October 24th, 1929, that borrowed confidence didn't just crack, it collapsed overnight. And surviving what followed would cost ordinary Americans far more than their savings. During the mid to late 1920s, the financial market transformed from an exclusive club for Manhattan financiers into an everyday household pursuit. Mainstream newspapers and bank advertisements framed stock ownership as a basic civic duty, a sensible strategy for any forward-thinking family. For the average wage earner, the gateway to this wealth was the brokerage office, which operated with the accessibility of a local grocery store. The mechanics of the boom relied on a simple transaction. An investor deposited 10 or 20% of a stock's price, and the broker secured a loan for the remaining balance. If the stock value climbed, the investor kept the entire profit, pocketing gains that far exceeded their actual cash savings. Under these terms, debt lost its traditional stigma. It became a tool of ambition. Working families adjusted their weekly budgets to cover interest payments, convinced that the upward trajectory of the market was a permanent law of the modern world. This systematic leverage built a vast network of personal debt across the country. Financial institutions aggressively promoted margin accounts to salaried clerks, school teachers, and small business owners, presenting speculation as a safe, respectable path to retirement. Because stock prices had risen almost continuously for years, the concept of risk faded from public consciousness. The danger was not a lack of caution, but the universal belief that prosperity had become permanent. By integrating the stock ticker into the rhythm of daily life, millions of ordinary households unknowingly tethered their domestic stability to the volatile movements of the trading floor. On the morning of October the 24th, 1929, the fragile financial system broke. By midday, the floor of the New York Stock Exchange was consumed by a chaotic frenzy of selling. In that single session of Black Thursday, terrified investors traded a record 12.9 million shares, desperate to dump their holdings before their savings vanished entirely. As stock prices slipped, brokers dispatched urgent demands for cash to cover the loans, the dreaded margin calls. Average wage earners who had borrowed up to 80% of their stock value could not produce the money on short notice. Brokers immediately liquidated their accounts, dumping millions of additional shares onto a market with no buyers. This forced selling spiral fed on itself, transforming a typical market correction into a devastating, self-reinforcing rout. The disaster did not end when the trading bells fell silent. It became a slow-motion catastrophe that bled the nation's wealth dry for nearly 3 years. The stock market did not reach its bottom until July 1932, a low point where American stocks were worth about 1/5 of their peak value. The ruin of individual companies showed the scale of the overreach. The Radio Corporation of America, the undisputed darling of speculative investors, watched its stock plummet from a peak of about $505 down to a mere $26 per share. Millions of ordinary families watched their financial security vanish, leaving them completely exposed to an impending economic winter. As the cold weather set in, the economic collapse forced millions of men into a quiet withdrawal from public life. For a displaced breadwinner, the initial reaction to joblessness was often a paralyzing shame. Many did not beg or ask for help. Instead, they drifted away from their neighborhoods, vanishing from the view of friends and former colleagues. Those who stayed in the city centers began gathering in the early morning darkness, huddling around rusted iron barrels and lighting trash can fires to ward off the chill. At dawn, figures walked through alleys, quietly sifting through garbage bins for discarded scraps of food or salvageable coal. By mid-morning, these individual struggles merged into a collective, visible desperation. Long, silent queues of men in worn woolen coats and battered hats formed outside municipal buildings and church basements. These breadlines became a permanent feature of city streets. In Detroit, Chicago, and New York, thousands of people stood in lines that wrapped around entire blocks, waiting hours for a single loaf of bread or a cup of hot black coffee. To stand in these lines was to put one's failure on display before the entire community. The humiliation was heavy, marked by downcast eyes and a near total silence. Between 1929 and 1933, nearly 10,000 American banks collapsed. The panic often began with a quiet rumor on a street corner, followed by a sudden rush of depositors crowding the sidewalk, desperate to claw back their cash. When these local institutions locked their doors, they suspended all operations and swallowed the entire life savings of millions of families overnight, turning basic financial trust into a casualty of the crisis. In New York, the collapse of the Bank of the United States in December 1930 left hundreds of thousands of depositors empty-handed, sparking runs that swept through the Midwest and rural communities alike. With bank vaults cleared and national unemployment climbing toward 25% by 1932, the physical map of the country changed. On the edges of major cities, displaced families gathered in makeshift settlements built of cardboard, tar paper, and scavenged timber. These communities, known as Hoovervilles, marked the absolute limit of the social safety net. The weight of this economic collapse fell with disproportionate severity on African American families. Often the last hired and first fired, black workers faced joblessness at double or triple the rate of white workers, with black unemployment reaching 50% in industrial hubs like Detroit. Under this intense financial pressure, the very structure of the American family began to break. Around 200,000 children became vagrants, leaving home to ride freight trains across the country in a desperate search for work or simply a meal. For these transient teenagers, survival meant sleeping in drafty boxcars and begging in unfamiliar towns as the basic stability of home and community vanished completely. Inside the home, the economic collapse broke the traditional structure of family life. For millions of men, the inability to provide brought a heavy, quiet humiliation. Losing a paycheck stripped away their identity as protectors, leaving them feeling useless at their own dinner tables. As men withdrew into silence, women took jobs in unprecedented numbers to keep their families fed. They worked in laundries, domestic service, and offices, sectors that were less affected by industrial layoffs. Yet the survival strategy sparked intense public backlash. Married women faced immense social and legal pressure to surrender their jobs, as school boards and local governments across the country passed outright bans on hiring wives. In 1933, the federal government intervened with emergency relief under Franklin Roosevelt's New Deal. Rather than offering direct charity, the administration launched the Works Progress Administration to put people back to work. WPA crews built bridges, paved roads, cleared public parks, and constructed municipal airports, turning relief into visible community labor. For the average laborer, the program paid $41.57 a month. It was an exhausting physical grind, and the wage was barely enough to buy basic groceries and cover rent. But for millions of households, this modest federal check became the thin line between starvation and survival, forcing Americans to redefine work and dignity. The breadlines vanished, but the fear of sudden ruin never left the American psyche. Today, we still live in the shadow of that fragile confidence, carrying the quiet anxiety of a generation that learned how quickly everything can disappear. What do you think? Share your thoughts below.